Hello, everyone. Welcome back. I am thrilled to be joined by our newest friend to Tranquilli financial advisor and money manager that we've worked with. He is Caleb Sevion. He is the founder of Focus Point Capital, and he's going to talk with us for about 20 minutes right now on a couple of topics that are always timely, but especially timely as we approach a presidential election. Caleb specializes in macroeconomics or macro analysis of economics, which I'm going to let him explain a little bit more about that in a moment. And he's going to give us some insight on the macro view of things and how it impacts his work and investments. And then we are going back to the third rail, as we've done previously with the other people that we've spoken with about investments. The third rail being politics. We're going to wrap up with that. So Caleb, thanks for joining us. If you would, give a better definition than I just did of macroeconomics and what you're looking at as part of the work that you're doing on behalf of Tranquilli financial advisor clients, or those people who are listening who aren't necessarily clients right now.
Sure. Well, first of all, thanks for asking to speak, Lou. Looking forward to it again.
Always fun.
And so my background is I'm a macro strategist. What that means is my job is to look into and understand economics, policy, politics, changes in society, to see how they all weave together and how those forces collide with the markets and understand the implications of investment implications for those forces on the markets.
All right, and
on stocks
and bonds as well, of course.
And bonds and commodities and all different asset classes.
Everything that has to do with it, different asset classes. Thank you. And one I think significant social change or social work change, of course, is the work from home environment, something you and I both do at this point. So that's something that you brought up at one point. And how has that factored into, before we get into the specifics of economics and their impact on your work, but give us an example of how work from home has maybe influenced your thought process of investments.
Yeah, I mean, I think it's a great example because I think that there's certainly policy at the highest level are the things that impact the things all the way down to the lowest level, which is the stocks that you buy, and right below policy. And the reason policy is usually the furthest thing in the background that controls everything is because policy in a lot of ways controls our social dynamics. For instance, when we have policy that forced us all to stay home, then we stayed home. That changed the way we all work, right? So the change in policy, which sits behind everything, actually influences how we behave and how we interface with the world. And as a result, office vacancy rates skyrocket to all-time highs in many jurisdictions. We've seen a complete collapse in commercial real estate prices as it relates to office spaces, where a lot of properties are trading for 50 cents on the dollar on the commercial property space because people are no longer going to work. Now, some of that, I actually wrote about this a couple of weeks ago. Now, some of this just recently changed when Amazon 2 weeks ago said they're requiring everybody starting to be in the year to be back at work 5 days a week. So we're starting to see a change, and this is similar to what we saw after the terrorist attacks in 9/11, is that things change dramatically, and then things go back to a normal, but it's a new normal. And the way we all interface with security at the airports, that's different. That created an entire new sector of the economy after 9/11, the financial crisis. We layered in regulation with policy that created, Dodd-Frank, that created all these policies that now change the way that the markets act, because as a result of Dodd-Frank, less companies want to go public. And so now we have less public companies. We actually have we have a lot more private equity. So policy sits behind everything and is controlling how we interface as a society with the markets. But it's to understand these are sort of the big long-term macro trends that influence, major asset classes.
Well, and I think it's important for everyone listening to hear that, because so much goes into this that isn't just, well, the economy is doing well, and we're going to move over to that now. And just a lot of us remember being able to roll up to an airport, get out of the car, grab our stuff, go through security, get on the plane. It changed, and unfortunate that it changed, but it changed, and we adapted, and we're doing the same right now. Personally, the effect of work from home has allowed me to work with teams all over the country, which is great, yourself included. We used to not have these conversations; they have to be on the phone. So, I think it's a wonderful thing, and I embrace it as it applies to working with the professionals that we work with, and of course the clients that we work with. So let's jump into economics. Your analysis of things, if you will. Previously, I've spoke with firms about Jerome Powell running the show, if you will. Everybody waiting with their drinks ready, hanging on every word. Your take on Jerome Powell being this front and center person, but the Federal Reserve, the entire board being different presidents of the Fed having so much in the way of sway on the markets when they speak. Your thought behind that?
Yeah, well, I mean, I think the important thing to recognize is that, is to step back, almost kind of blur your eyes, and see where things are headed. Things are headed. We hit the peak of inflation. We hit the peak of interest rates. Those have rolled over, and now the Fed is in a zone where they are cutting interest rates. As long as they're cutting interest rates because they're trying to recalibrate or normalize the interest rate back down to the neutral rate, which is where they want to be, right? The Fed should be out of the way. If inflation is actually back to where it should be, the idea is for them to get out of the way. What does it mean for them to get out of the way? It means for them to get the policy rate back to neutral. The best estimates of neutral today are probably somewhere between 2 3/4 and 3. And so we've got a long way to go to get to neutral. Now the question is, how fast do we get there? Now I think, we'll segue into this and later in the discussion. A lot of this is going to depend upon the election, who wins, what policies come with the election win, because some of that will control what happens with inflation. But right now, what's happening with inflation is it's moderating, which is allowing the Fed to move policy back to where it goes. Now, normally when the Fed lowers interest rates, it's because they're trying to avoid a crisis, right? A crisis has happened, or they're trying to avoid a crisis. And right now, there are no signs that a crisis is happening, right? There's no smoking gun in the economy saying that the economy is about to sail off a cliff. People were worried that the employment market was headed south when things like the Somme rule were triggered. The Somme rule is when the employment rate moves 50 basis points above the 12-month moving average, which it triggered last month, and then it untriggered this month. And so people were worried that the employment market was going to deteriorate rapidly. But as of the latest employment report last Friday, that doesn't appear to be the case. And this, which gets to another point, which is sort of touches on another thing you asked, which is, who is this guy Powell and what's he doing? He's got a very difficult job right now. Historically, the way that the Federal Reserve had operated is they operated on a combination of their forecast and looking at the data as it came in. Well, what's happened since the pandemic is that their forecasts haven't worked. The data hasn't behaved the way it typically had behaved. And some of the data is just flat broken. Survey data has just been negative ever since after the pandemic. And ever since inflation spiked, prices moved up roughly 21%, and that made everybody feel horrible. And as a result of feeling horrible, anytime you ask somebody how it's going with their business or how they feel the economy is going, they say it's awful, right? Because they feel bad because prices have increased so much. 21% sounds like an average, but because a lot of things are up 60, 70, 80, 90%, right? Or even more. And so people feel very negative. And so the survey data piece of how they measure the economy has been broken. That feeds into their forecasts. Their forecasts have been broken. So what they've done is they said, hey, listen, we would like to be data dependent. And And that gets into this very slippery slope of being data point dependent. And you have to differentiate, because if you're looking at data, that means you're looking at trends in data. If you're looking at data points, you're looking at the last data point. And so what's happened with the evolution of the last year or so is the markets have been continuously evolving into becoming data point dependent. And so what you see is these dramatic swings of both the equity and fixed income markets as a result of individual data points. The data point on Friday with the non-farm payrolls number and unemployment rate falling in non-farm payrolls going, three standard deviations above the closest estimate of what they were going to be, shows in the bond market's reaction to that, the Treasury market's reaction to that was, unprecedented. I mean, the two-year Treasuries moved something like 35 basis points, which is just a massive move that we just don't typically see. So we become so data point dependent, it makes the Fed's job very, very difficult.
All right. And I want to stop there for a moment because the data point, I think that's a great, no pun intended, point to stop at. In other words, what you mentioned it yourself, some of the data or the information previously relied upon is broken. Is it broken because now we're looking at data points rather than looking at broad, expansive periods of time within the economy? We're now down to data points. And of course, point arrives, reaction occurs, new point arrives, another reaction occurs. So is the data point the cause for the broken data that they're relying on, or is the data that they've been relying on broken because now we just want to get to certain data points?
Yeah, so it's an interesting differentiation and question, because when I say the data is broken, certain pieces of data have not performed like you would expect them to. Like typically, I run an econometric model for Focus Point Capital. We look at 28 different indicators of the economy. And I like to think of it as a mosaic we see against the wall. And it tells us by looking at the economy, looking at the markets, looking at liquidity situations, looking at valuations. We look at all these different factors, and then we can kind of say, is it all generally good, or is it all generally bad, or is it all generally great, right? And that provides us an advantage, because what typically has happened is a lot of forecasting models rely on things that have historically worked very well, like the yield curve, like survey data. These mechanisms, they're part of our model too, but they're one of 28, right? So they don't, by themselves, they don't have the ability to completely sway our model. And so what a lot of these econometric models will do is they'll focus on what have traditionally been the forward-leading indicators. And what you end up having as a result is you have models that give you nonsensical results, because you have survey data that's horrible. No one even answers surveys anymore. The non-farm payroll on Friday, the response rate was 43%. It's a payroll survey. The non-farm payroll survey goes out to people, and they fill it out and they send it back to the Bureau of Economic Analysis, or to get tabulated. But when 43% of people fill it out, now they'll keep sending it to you. I'm sorry, it's a Bureau of Labor Statistics for that one. But they'll keep sending it to you for you to fill out. But that's why we get these revisions. So even though we were up 254,000 jobs last month, we're going to get some large revisions, because the probability, if you look at the error bar on that, within a 90% probability, it's plus minus about 125,000 jobs. So it's just a extremely wide error bars, because people aren't answering surveys. And so, what you really need is you need to look at a broad enough, and Powell talks about this when he talks at his press conference. He said, we need to look at the data in totality in order to try to understand what we're going to do. But what we saw as a result of last week is there was an expectation that interest rates are going to be cut 50 basis points in November, and that pretty much just got erased on on Friday, and now people are thinking 25 basis points. And so, and you'll see these, swings. Now, we still have one more payroll report between now and that meeting, and that payroll report could be very bad. It's going to include the effects of the Boeing strike. It's going to include the effects of the hurricane. So that one, when you go data point dependent, you end up with a lot of volatility.
Sure, and it makes perfect sense. You can't take a broad look at things. You're just waiting for everything to culminate in a point, and again reacting to that mass of data rather than taking in some of it at a time. And you bring up non-farm payroll, and 43% of the participants responding to it, and a revision possibility of 125,000 out of 250,000 jobs. Well, 50% of it could be useless data. And go back six months or so, and there were significant revisions made to payroll or made to jobs reports, and people were saying the jobs reports were fake or false. They weren't fake or false. They were just updated as they've always been updated. However, it gave an opportunity to comment, if you will, on how it changes, but no context of the fact that 43% were responding. So it's of great interest. It rolls into the next topic, which I said we were going to keep this to 20 minutes. We're going to get close, okay? Because when you and I get talking, man, it's tough to keep it. We're not short for words. That's a certainty. All right, so let's talk about politics. The saying and the data points out that over time, over a long period of time, not using data points, but breaking it down to years of presidential election, the stock market, generally speaking, is up during years of presidential election. Now, I have to give it some qualifiers. 80% of the time there's a presidential election, the stock market is up. Using example numbers, not real numbers, if it's usually up, say, 7% during the year of a presidential election, it'll be up somewhere around 5.5%. So it certainly has some kind of impact. It doesn't necessarily have an impact until right now, because we are within shouting distance of the presidential election right now. So add in the volatility you're talking about and reading data points into politics. How are politics impacting your thought process right now? Are they impacting your thought process? And let's not go left or right. It doesn't matter. Again, data shows that neither left nor right are better for the market, worse for the market, but it certainly has an impact on the confidence level in the market and the volatility of the market. So if you could comment your comments on politics as part of Focus Point Capital's thinking right now and moving into 2025 even.
Yeah, I think it's important to point out that we tend to overestimate the president's impact on the economy. The economy is measured through GDP, employment, inflation. These are measurements that the president impacts for sure, but these aren't measurements that the president themselves control. And they're only one branch of government. And without controlling the administrative branch, the presidency, and Congress, there is a limited amount that the president can accomplish. So a lot of what we see from both parties right now is that they call it kind of Vibenomics, because they talk about, both sides are talking about vibes, not necessarily their specific proposals. Now, they've gotten a little bit more specific in the last couple of weeks. I think the Harris campaign about a week ago put out a 82-page economics draft, and there's a little bit of meat in there, but it's still pretty thin. It's still Vibenomics, and I think but if you look at where what the probabilities are, right? It's a dead even race right now, and the chances of either party getting either a red wave or a blue wave, of either party getting Congress on their side, is somewhere around 10, depending upon which poll you look at. It could be as low as 8%, could be as high as 15%. So the probabilities are pretty small that either of them will be in a position, and they're not they're not non-existent, but the probabilities are pretty small that either of them will be in a position to really get their agendas through. Now, having said that, I think that, the presidential election, by the way, is the polling is very skewed. Like my way of looking at the polling is probably slightly different. When you look at the last election that Trump was involved in, between Trump and Clinton, Clinton won the election on popular vote by 3 million votes, 62.9 million to 65.8 million. But Trump won the Electoral College by 306 votes to Hillary Clinton's 232 votes. So a lot of the polling that happens as a result of how, it's not polling. The polling is not based on the Electoral College. The polling is based upon the popular vote, which is in and of itself creates some problems on thinking about how that's going to work. But if you look at policies, probably a really good way to think about the impact of the policies is looking at the two debates, because the first debate, the general takeaway was that Trump had a better debate and Biden had a worse debate. And then the next one was that Harris had a better debate and Trump had a worse debate. So they each have one under their belt. And we can look now at the markets and see how the markets performed. And what we see is that when Trump was perceived to do better in the debate, the alternative energy stocks took a hit. They were down between 10 and 15%. Conversely, when it was perceived that Harris was perceived to win, the alternative energy stocks were up 10%. Pharmaceuticals were down for Trump, up for Harris. Tobacco stocks, up for Trump, down for Harris. Oil and gas, up for both of them, a little bit more for Trump, which is interesting because if Trump were to get in and reduce regulation and open up the lands and make it easier to produce oil and gas, that could actually lower the price of oil and gas, because you'd have more supply, and that potentially could be negative for oil and gas.
Long-term negative. Yeah.
Long-term negative. And then semiconductors. This one actually I was a little surprised. They did a little bit better. Tech did a little bit better in semiconductors for under Harris doing better. A little bit worse. They both were positive, but but they were up. This is measuring a week after each of the debates. They were up under the Harris about 6% and under Trump about 2%. So both of them are perceived to benefit there. I mean, I think the other sort of big takeaway is that, and we know this, that Trump is expected to be more business friendly. Harris is expected to be less business friendly. In that, potentially, but their gaps on that are narrowing. Like the Harris, like when you look at the Trump wants to cut the corporate income tax. Harris wants to raise corporate income tax. But when you look at where Harris wants to raise it to, it's just a fraction of what.
It's negligible, correct.
Yeah. Compared to Biden wanted to raise it to 44.6. Harris wants to go from 21 to 28. Trump wants to go from 28 to 15. Listen, like I said before, none of this is happening without Congress.
Correct. Yeah, I was just about to bring it back to that. In other words, they can do anything. They can want to make it zero. It doesn't matter. There are others that get to decide this, and they certainly it's. I think you stated it correctly. The impact of the president is a bit overstated, especially in how it impacts where our work comes in. We have to be sensible about how we approach either side, and that's what we're doing. So, Caleb, I'm going to leave it there. Okay, Caleb Sevion, Focus Point Capital. Great to have you here. We'll have you back in 2025. We'll talk about whomever is the president at that point. It will be historical either way. So that'll be something to talk about in and of itself, and we'll have a better vision after the beginning of November. So thanks so much for joining us. I do have to get this in. We are in the National League Division Series, so let's go Mets. All right, I just Really want them to beat the Phillies. So everybody watching this, let's go Mets. In case you don't know it, I'm a huge Met fan. I have been since 1973. But Caleb, thank you for a little bit of time and expertise in discussing this. And you come back and do it again at some point.
Yeah, look forward to it.
Outstanding. Thank you.